likes of an Infosys, a TCS, a 3, 4, 5% correction. Would you buy in?
Morning to you and all your viewers.
Very good morning.
Yes, after yesterday's pivot, what we've seen from the US-India deal, I think any correction in the IT sector should be a good chance for us to actually start accumulating. Because if I remember it right, basically, I think most of the Indian mutual funds are either neutral to negative as far as weights are concerned on the IT side. And I think with this kind of a pivot, basically, which we have seen yesterday, I think it could be a good chance to start accumulating. Valuations are in our favor. More and more companies are coming out and guiding for a better 2027. So that's why I think basically it's a good time to start looking at these.
And no risk that you see from AI creeping into or eating into Indian IT sector revenues?
I think that trade has already been played out. So there is nothing incremental which Anthropic, which we put out another model basically yesterday, is going to actually change anything. So I don't see anything that's already got played out. I think eventually when you start moving away from the LLMs to actually use cases, that's where the Indian companies are going to start getting business. And I think that thing has started happening. So I am actually rather more enthused to see that this could be a good time to actually start accumulating these stocks.
That's quite interesting. Kunal, is that your take as well? And if so, what's the preferred IT list?
So I would still believe HCL Tech and Tech Mahindra should be the preferred bets over here. But my only concern over here is that if in case these stocks open with a 3% or a 4% cut, and if those cut is not bought into immediately or maybe throughout the session today, then there could be a change of stance which could happen from indicators. Many of the indicators, for example, for the IT index, the RSIs, the MACD, etc., they were floating about the neutral territory, which means that there was a case that maybe this time-wise consolidation as well as a price-wise consolidation for the IT index could probably be bought into, and the resultant effect would be the breakout on the upside. But if these stocks, confirm a breakdown of sorts on the daily charts, then I would believe that the recovery could be a lot more delayed for the IT names. So that's why I would probably just about keep it under wait and watch today. If in case there is a recovery, then yes, the bullish stance on the IT index continues. But if in case the recovery is not bought into, then I believe that one should probably try and just keep it on the sidelines.
Kunal, your picks in this market?
So a couple of buy calls. MCX is something which I would believe could be interesting buy at current levels, specifically with a 10% correction. The stock has already shown in the last 3-4 days of the price correction. So I think in that sense, 2,560 is where I would place a target for MCX over the short term. Stop loss could be kept at 2375. And from the private sector banking names, mid-cap name Bandhan Bank is something which starts to look attractive. The stock is forming a bullish flag formation on the daily charts, nearing a swing breakout, strength from the indicators on the daily time frame. Would look out for 161 as a target, stop loss at 151.
Let's talk about Bajaj Finance as well. And Sajid, like you were highlighting, it is a case of higher provisioning, but then that's, just contingency and just being a little extra more cautious, and there's not much to read into it, right?
Yeah, I mean, ideally not. At least I wouldn't. And essentially, what the commentary seemed to suggest was that they're just trying to be more conservative across parameters. This is not something that they will keep rejigging all the time. This is something that they've done once in many years. They've gone back to the drawing board, and they've said that we need to hike our PCR, which is provisioning coverage ratio. And when we do that, we will have to provision a certain amount. The amount comes to 1,406 crore, which coincidentally or non-coincidentally is largely in line with the quantum of gains that they've made from Bajaj Housing Finance, from the sale of Bajaj Housing Finance shares on the market that they've done this quarter as well, which was 1,466 crore. That 1,466 crore does not reflect on the P&L, viewers. That's something to kind of note, because on the consol numbers, they consolidate Bajaj Housing as well into the consol numbers, and therefore they can't reflect that gain on the P&L, but it does get added to the net worth of the company. and therefore it's a straight balance sheet entry. On the standalone numbers, of course, it does get reflected, and therefore you're not seeing that in your profitability number.
Right.
So largely from a PAT perspective, it's negative, of course, in the current quarter, but outside of that, I wouldn't read through too much into it. In fact, the credit cost guidance has actually been cut. It's now 1.65 to 1.75% for FY27 with the additional provisioning that they've been doing across the board.
Right. Just wanted to get your sense as well, Nishal, from the entire NBFC pack, anything after the recent correction that you would want to buy into?
So broadly, I think NBFC pack is going to be a beneficiary this time, given that you have got a cost coming down, credit cost is now more or less benign. But the result which I've seen, I think L&T Finance looks very interesting to me. They are guiding for a very strong number outlook. Basically, the growth has been pretty good. Even the credit cost has been pretty okay. And I think the valuation is another one, basically, which you should be comfortable with. So I think within what all has been already declared, I think within the NBFC space, L&T is one basically, which I would actually look at.
Nishal, how do you look at, we spoke about the IT stocks briefly earlier as well, but, do you see the kind of reaction we saw with some of the ADRs, Indian IT tech ADRs in the US? You're going to see a similar one in the Indian market as well. Though, many of them already have those kind of models, they're servicing their clients with those kind of models.
Yeah, I think Indian market is very much aligned to what happens in the US, and given that the sentiments are not very strong as far as India is concerned, though there is, I think, some amount of pivot yesterday. So I think any reaction across the world, basically, especially on the IT side, given it's a global sector, you will see reactions here. And I think that's what I was telling you earlier, that it could be an opportunity to actually to start accumulating these stocks.
Some of these value retail companies, they're posting very strong numbers, but within that pack as well, V2 is really standing out. Your view with regard to some of the numbers, do you track it closely? Do you have a preference in terms of pecking order within this value retail space?
Yeah, so my topic is also V2 retail only. Basically, I think they have done a phenomenal job in the last now almost, I think, 3 or 4 quarters. And they continue to guide very strongly. Now, I think the question remains to be basically at these valuations, what one should do because what we've seen with happening with Trent at some point in time, I think on a higher base, doing a 50-60% kind of a growth would be a difficult task for any company. And I think that's why I think at some point in time, you should be cautious, because if you are giving this kind of multiple for a high growth, at some point in time, that growth is not sustainable. And that's why I think some amount of maybe profit taking is called for at these levels.
Interesting. Kunal, on charts, V2?
Yeah, it's been a much better name as compared to maybe if I can consider something like DMart, etc. Such other stocks, because those stocks have underperformed. V2 retail, on the other hand, I think the stock, even after running up almost 10-12x from post-COVID era, I think from 200 levels or sub 200 towards 2600 mark, which was the high in 2024 for the stock. It's gone through a very reasonable correction for itself, has come back towards 2150, 100 level, very tested yesterday. I think there could be a decent chance of a recovery in place for V2 retail. Also, I think the major support for the stock, where over the last 2-3 years the stock has tested this zone and bounce back, is around the 1800 mark. Even very recently, just about a couple of months back, the stock took support at the 1800 levels and bounced off. And I think 2023-24 also, I think the stock has shown a very similar kind of a price support. So that, I think, should be a very strong medium to longer term support for V2 retail. It looks to be that the stock would probably try and come back into a recovery mode further.
Okay. The other one, again, which came out with a very strong set of numbers, is something like a Triveni Turbines. The revenue was up 24% on a YOY basis, 624 crore. Record quarterly revenue is what it clocked. Estimates pegged the revenue number at around 575 crores, so it was substantially higher. EBITDA at around 134 crore was largely in line, margins slightly below. But when you're looking at the profitability, it was at 101, it was at 92 crore, I beg your pardon, with some one-offs, of course. There was a 15 to 16 crore one-off on the back of labor costs. So again, you saw a decent set coming out from a Triveni Turbines. The other one that stood out for me was a Choice International. Now, relatively smaller name in that sense, but we saw again very strong numbers. The top line was at 303 crore versus the 209 crore same time last year. Operating profit or EBITDA was at 112 crore versus the 60 crore number same time last year. Margins continued to get better. 37% is what the EBITDA margin stood at, and profits more than doubled from 31 crore to 66 crore. That's the other one that should well be on your radar today to try and see as to what the moves could well be. Nischal, you also had an update from Angel One come in, which wasn't half bad, frankly. 10% lower trading days, but trading volumes were higher by 14 odd to 15 odd percent. The average trading volume, average daily trading volume was higher by nearly 25% on a month-on-month basis. So we've seen much, much stronger numbers. But of course, STT could be the dampener. How do you look at all of these moving parts within the broking kind of businesses?
So I think we have to start looking at it broadly. Basically, if we really look at it, government is indicating to you that they are not very keen to push and support the F&O volumes. And stocks, companies and broking houses which are focused more on the F&O side would keep on suffering. So I think this is the second or third time government has come out. Basically, first they reduce the number of weekly expiries, and now this kind of increase. So I'm saying government is very clearly indicating that this is not the volume which they prefer. And most of these broking houses have to adjust to that. So broking houses which are more focused on, I do not track Angel One, so I'm not very sure, but I believe most of the broking houses have large volumes because the volume is happening somewhere. So all of them, given that the market share they own, must be having that. So I'm saying basically at the moment, one should be cautious on the broking houses.
Nishal, do you think that the regulatory uncertainty which we saw 2 years back in F&O and we thought that it's stabilized is still not over yet? I mean, you saw the finance minister putting in STT. Is there a possibility that the regulator also may come in here?
See, I'm saying if you really look at government's last two actions, it is very clear saying that they do not prefer this kind of volumes which is impacting the retail investors. They do not favor that. So I'm saying the direction is very clear and that there is no point on unnecessarily second guessing that. So it's very clear. I think you will continue to see this regulatory uncertainty. There would be something possibly coming from the regulator also in due course of time. So I think the tightening will continue to happen.
Okay. On some of these AMC come brokerages, come exchanges, any of them that look attractive on charts, Kunal?
So I think as in pocket overall, I would believe that the AMC names, the broking firm, the broking houses names, the exchanges, etc. I think these stocks have done very well for themselves. Of course, they've been a little bit more volatile than the other clusters because of the nature of the business these stocks are into, and especially I think even the last 1.5 odd year, where we were mired with a lot of volatility as such, specifically with regards to the Indian markets and various asset classes, not just on stocks but even on bullions, etc. So I think in that sense, yes, these stocks would probably have been a little bit more volatile. But then we'll have to look at this in the spectrum that once the volatility stabilizes, many of these stocks would actually throw in good opportunities. For example, from the broking firm names, look at Angel One. The stock has done very well for itself. After a 10% correction or a 15% correction broadly, the stock throws in a very good opportunity for a contra buy. I think we've seen 2,300, 400 as a huge support for Angel One, and the stock keeps on bouncing back from the exchanges. For example, BSE is one stock which I think around 2,500, 2,600 thereabouts seems to be finding very good support. You've seen multiple corrections being absorbed by the stock at those levels. MCX has done phenomenally well, even with the special situation prices for MCX at 2,300, 400 levels. I think the stock has done excellently well over the last few years and continues to look very attractive at current levels. So I think one has to look at this as a spectrum that volatility would be a part and parcel of this sector. But then I think the longer term charts are still very bullish. Opportunities of a say a 20%, 15% correction should be taken as an opportunity to average or accumulate further.
Okay, so MCX clearly is something that Kunal seems to be reiterating. The other, set of stocks which could well be in focus is some of the amine names, and alkyl amines comes straight to the fore with regard to the numbers. They didn't look enthusing in that sense. In fact, a difficult set, if I can call it that. I'll quickly read out the numbers to you. 354 crore in terms of top line versus 371 crore YOY, so it's down 5% odd. You saw PAT as well down 3% odd, EBITDA down 5%, and margins at largely 19%. Now the estimates suggested that the top line will come in at 42 crore versus the 421 crore versus the 354 crore number that they clocked. So 20% higher was what the estimates pegged this at. And in fact, PAT also was expected to come in at least 20% higher from what the numbers were and what the numbers came in. Now, Nishal, let me come to you with regard to some of the chemical names, some of the amine names. We've been talking for the last, over a year now with regard to when does the turnaround come in some of these names. When does it come, in your opinion?
So incrementally, if you really look at it in the last 2 quarters, most of these guys have started saying that there are 2 things which are happening. One is the Chinese involution, basically, where China has started giving lesser amounts of benefits to their chemical companies. China is pivoting away from low-end production to high-end production, as you see basically broadly, and their exports also in the same way. So I very clearly see now more and more companies. I have been on few calls of these chemical companies. They have started saying that they are going to start seeing benefits of Chinese involution, basically. One is that. If that happens, basically, you are going to start seeing margins start going up within the sector. Volumes have already recovered. In the last 2 quarters, we see most of these guys have started indicating that volumes are good. So one is that. The second thing is more and more companies, especially out of Europe, where the cost of energy is really gone up because they have shifted away from the cheap Russian energy. More and more companies are trying to outsource. And that's a very big space, basically, which I see when we speak to companies, that they have got very strong inquiries coming specifically from Europe. And now I think the issue has got sorted out with the US also. So you are going to see once again strong growth coming back from the US, as well as strong inquiries to outsource. So I see chemical sector in a very good shape in the next 2-3 years. Valuations are pretty good, and pretty interesting results also in the current quarter.
Okay. Understood.
If you look at defense stocks now, you now have a decent understanding of what the budget has for some of the defense sector, especially capital spending there. The India-US trade deal is also talking about defense purchases. Then you have the European deal where you're talking about collaboration for setting up facilities in India. From a long-term perspective now, do we have much better understanding of how the defense space is now going to evolve here?
So, see, as far as defense business is concerned, there was never a worry, basically. If you look at the order books of all of these top companies, I think they have got visibility of 5-6 years very clearly. So there are 2 issues, basically, which I always used to highlight is the valuation. And that valuation thing basically still doesn't get sorted out. So though they have corrected, but I still believe basically valuations, if I look at the numbers, valuation is still a bit aggressive. So I would wait basically maybe now the stocks may not go down, but the time correction is definitely bound to happen in these stocks.
Okay. So you'll have those in focus as well. Then you had the likes of an AB Capital also, which came out with numbers, a decently strong set of numbers coming out from there. Restaurant Brands came out with numbers as well. I'll quickly read out the numbers to you. The revenue number was up around 12% odd. Margins were in fact better than what even estimates were, even though top line was slightly softer. And EBITDA was again ahead of what the street was penciling in. It was the PAT number which also came in at a decent 46 crore versus the 50 crore number same time last year. So it was down around 13 odd %, but it was much better than the estimate of a loss of 37 crore. So Restaurant Brands Asia will be the other one which will be in focus, frankly. And then there's Lloyd's Metals. What a stupendous set of numbers coming in from Lloyd's. The revenue has gone up from 1,700 crore to 5,000 crore. Profit after tax at 1,047 crore versus the 390 crore number. So very, very strong tailwind in terms of numbers. Margins also going up from 32% to 34.5% plus, in fact, in terms of EBITDA margins, where you see for Lloyd's Metals in particular. Nischal, let me come to you with regard to the metals pack, and of course the moves on gold and silver leading to the moves even on the likes of a Vedanta, Hindustan Zinc, even a Hindustan Copper. Would you at all bet on any of these names at this juncture? Given the kind of rally we've seen, is it a good time to buy in even now?
So I think ferrous names have not done really as strongly as the non-ferrous ones. And I think ferrous could be still a good place to be in. Possibly Vedanta. I think Vedanta, after the split, there is a lot of value out there, and I think that is going to get unlocked. So I think ferrous stocks and Vedanta looks interesting to me. I think the others are sort of an avoid at the moment.
Understood. Okay, Nischal, great to have you on the show. Thank you so much for your time today. Just counting down to the
Thank you.
market.